Here at jeffglass.com, there's a collection of case studies in my proof section that illustrate how many owners of commercial real estate have stopped overpaying their income taxes. One way they've done this is by correcting the way they calculate depreciation expense on their buildings. That's one of the best kept secrets in commercial real estate investing. As I'll cover in a moment, the IRS acknowledges that most property owners are overpaying their taxes by depreciating their buildings too slowly. But it's up to building owners to find out about that and take corrective action. Have you? To understand what I'm talking about, consider that commercial real estate is normally depreciated for tax purposes using 39-year straight-line depreciation, or with apartments, it's 27.5 years. And most buildings are set up on the books with one of those two lengthy depreciation periods when they're built or acquired. But if you think about it, buildings are complex assets that include many items in and around them that really don't last that long, or they've become obsolete and they need to be replaced sooner. For example, does carpet really last 39 years? Nope. And as it turns out, there are many items comprising the so-called real estate that, although affixed in some way to a building or the grounds surrounding it, aren't actually real estate as defined by the IRS, including things like mirrors, fire extinguishers, data cabling, decorative woodwork, specialty electrical and plumbing, and a lot more. And that brings me to my main point. One of the least known tax breaks for commercial real estate owners is the ability to write off the cost of a building faster than the usual 39-year depreciation schedule. And here's how that came about. In 1997, the IRS lost a landmark court case. Now, in that case, the IRS admitted that the correct way for property owners to depreciate real estate is to segregate the building's cost into separate classes with short, medium, and long-term depreciation lives. However, as the IRS official giving testimony during that case said, "We're not going to tell them that." Now, that somewhat flippant remark probably tilted the outcome of the case against the IRS. And the outcome set a precedent enabling millions of commercial real estate owners to dramatically lower their income taxes and increase their cash flow during their early years of ownership. Since that time, the IRS has allowed owners of depreciable real estate to separate its cost into several categories. The first category is personal property, such as carpeting, which is usually depreciated over 5 years. Then there are land improvements, such as concrete walkways, pavement, landscaping. All these are considered to have a 15-year life. Everything else, including the structural components, are all the depreciable real estate, which is 39 years for commercial and 27.5 years for residential. Most buildings have between 15% and 50% of their costs that can be reallocated into these short-term depreciation lives. And by writing off the short-term assets faster, you can reduce your income taxes and increase your cash flow. Now, how can you be sure that the IRS accepts this? Well, I mentioned that the IRS has said most property owners are not depreciating their buildings correctly, and that's a fact. For example, take a look at what the IRS wrote in September of 2016 in a guide for their auditors, and I quote, "If the taxpayer acquires carpeting as part of the acquisition of the building, and the taxpayer incorrectly treats the carpet as building structural component, then the taxpayer would be incorrectly depreciating the carpet over the 39-year recovery period of the building," unquote. Now, the IRS doesn't require property owners to take advantage of short-term depreciation as seen in the courtroom testimony. They would rather not have you do it at all. But it's an acknowledged fact that the correct depreciation period for carpet and many other items in non-structural property found within typical commercial buildings is 5 years. Now, at the same time, the majority of property owners are missing out on the option to write off parts of their property much faster because they simply don't know about it. Savvy accountants appreciate that cost segregation is beneficial. Here's what one CPA said in the Journal of Accountancy. "Cost segregation studies can provide real estate purchasers with tremendous tax benefits. Buyers of real estate should obtain an engineering report that segregates assets into 4 categories: personal property, land improvements, building components, and land," unquote. And besides lack of awareness, the biggest challenge to implementing this concept is that property owners have no idea how to make the split of their building cost into those categories. And not surprisingly, neither do their accountants. Nevertheless, the IRS expects legitimate engineering-based proof. Again, let's look at the impact of that court case that I mentioned. The taxpayer that won that case against the IRS actually hired a team of construction engineers to determine how the cost of their building should be segregated. The court accepted that approach and imposed it on the IRS. As more proof of cost segregation's legitimacy, in 2006, the IRS wrote a lengthy guide on cost segregation that explains their expectations on the matter. And these expectations include their strong preference for an engineering-based study to correctly determine the breakdowns. Now, because accounting firms didn't have the engineering expertise to get this done, beginning around 2000, specialized cost segregation firms arose to meet this challenge. Now, property owners can hire a cost segregation consulting firm that has expertise in construction, cost estimation, and the relevant areas of tax law and regulation to prepare a study of their buildings that allows them to determine how they should be depreciated. So what does a cost segregation study do for you? The typical result of these studies is to create enough accelerated depreciation that, over the first 5 years of ownership, owners are likely to be able to write off 10% to 20% of the cost of their buildings over and above what they would have written off using straight-line depreciation. Now, that translates to 4% to 8% of the building cost in tax benefit if you're in a 40% marginal tax bracket. If you own a $10 million building net of land costs, we're talking about tax savings of $400,000 to $800,000. When should a cost segregation study be done? Ideally, as soon as an owner puts their property into service. However, if you've owned your building for some years and did not apply cost segregation to your depreciation method, it's not too late. The IRS allows you to catch up on accelerated depreciation not taken in past years without amending past tax returns. In fact, this situation is more common than applying cost segregation to new construction, simply because most owners find out about the possibility years after building or buying their property. Even buildings owned for 10 or 15 years can be good candidates for accelerated depreciation if the initial cost basis is high enough, generally $1 million or more. Do you want to be able to keep more of what your building earns? Do you want to be able to deduct 10% to 20% of your building cost above your usual depreciation deductions? 2 words: cost segregation. Contact me if you want to discuss whether it would apply in your situation.